Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a $10 billion AI bombshell rocks the semiconductor world, setting up a battle royale at the bell. Watch for high stakes positioning as this news could trigger a violent rotation out of the market's biggest winner. Second, Nvidia's $5 trillion throne under siege. A stunning $10 billion OpenAI deal ignites a new AI chip war. This isn't just a new contract, it's a strategic power play to end single source dominance. Is Nvidia's unprecedented pricing power about to evaporate at the open? Finally, crisis alert. US healthcare spending skyrockets to a record $5.3 trillion, hiding a major threat to the Fed's inflation fight. The headline number is shocking, but the hidden truth is worse. The chaotic Medicaid unwinding is causing administrative costs to explode, signaling a new wave of sticky inflation that could crush insurer profits. The interest rate safety net that investors relied on has been pulled away. The narrative that fueled the December rally, the expectation of Federal Reserve rate cuts, has been fundamentally challenged by a shocking forecast from the country's largest bank. While the Nasdaq Composite shed 1.0% on Wednesday, led by a sharp rotation out of technology, the equal-weighted S&P 500 actually managed a marginal gain. This divergence is the loudest signal on the board. Capital is not leaving the market. It is aggressively fleeing concentrated mega cap exposure and rotating into the industrial and defensive sectors that have been ignored for too long. The primary catalyst for this repricing is the revised forecast from JP Morgan's chief US economist. The bank has officially moved its expectation for Federal Reserve policy to 0 rate cuts in 2026, with a potential return to rate hikes by the third quarter of 2027. This is a massive departure from the consensus view that lower rates would arrive to support high equity valuations. From a policy perspective, this suggests the Fed may be locked into a restrictive stance due to persistent core inflation and resilient economic data, such as the 5.1% surge in existing home sales reported for December. The impact on capital flows and valuation is immediate and severe. Technology stocks, particularly the Magnificent Seven, are trading at multiples that mathematically require declining discount rates to be justified. If the 10-year Treasury yield holds above 4.14% or rises on this new hike expectation, the present value of future cash flows for growth companies is automatically slashed. Analysts warn that if rates remain elevated through 2027, the Nasdaq's forward price to earnings ratio faces a necessary compression of 15 to 25% to align with the cost of capital. This explains why we are seeing a mechanical sell-off in high multiple names despite no specific negative news from the companies themselves. The earnings picture is further complicating the bullish thesis. We are seeing a critical distinction emerge between headline beats and quality misses. Wells Fargo, a key bellwether for the commercial economy, reported earnings per share of $1.76, beating expectations by 6%. However, the stock fell 4.6%. Why? Because revenue missed estimates, coming in at $21.29 billion, and net interest income is compressing. The market is punishing companies where profitability is driven by cost-cutting or one-time items rather than organic revenue growth. This signals that the higher for longer rate environment is now squeezing bank margins as deposit costs rise rather than boosting them. In the technology sector, a similar red flag was raised by Broadcom. The semiconductor giant beat revenue expectations with an impressive 74% growth in AI revenue. Yet the stock plummeted 4.2%. The concern lies in the margins. Broadcom's gross margin guidance dropped to 76.9%, a sequential decline. This is a critical data point for the entire AI narrative. If a leading chipmaker sees margin compression while revenue skyrockets, it suggests that pricing power is eroding as competition heats up and customers negotiate harder. Investors are interpreting this as a signal that peak profitability for AI hardware may be behind us, prompting a re-evaluation of the entire semiconductor complex. On the geopolitical front, the risk premium in energy markets evaporated almost instantly. Crude oil prices dropped over 3% after President Trump stated that Iran had halted executions, de-escalating immediate tensions. While this eases inflationary pressure from energy costs, it triggered a rapid unwinding of long positions in oil majors like Exxon and Chevron that had been built up as geopolitical hedges. The market rhythm has clearly shifted from momentum chasing to quality verification. The divergence between the cap-weighted indices and the average stock tells us that the growth at any cost trade is unwinding. The next 48 hours are critical as we await earnings from Goldman Sachs and Morgan Stanley. Investors will be watching to see if investment banking revenues can offset the margin compression seen in commercial banking. If the financial sector cannot demonstrate high-quality revenue growth, the rotation into cyclicals may accelerate further. This is not a time for complacency. The market is demanding proof of earnings durability in a world without rate cuts. Heading into today's open, the AI chip war has a new blockbuster contender. Overnight, AI chipmaker Cerebras announced a landmark deal with OpenAI, the creator of ChatGPT, worth over $10 billion. We previously noted their earlier collaboration on OpenAI's GPT-OS models. Today's news is that relationship scaling into a multi-year industrial-grade commitment. So the thing is, this deal's significance goes way beyond the headline number. It's measured not just in dollars, but in power consumption, 750 megawatts. To put that in perspective, that's enough electricity to power a small city. This signals a new phase in the AI arms race, where securing massive amounts of energy and computing is becoming the key bottleneck. As we flagged a while back, the AI infrastructure capex boom is colliding with power constraints, the end of cheap compute theme, and can feed pocket inflation. This escalating scale could even create inflationary pressures on specific inputs like energy and data center construction, something for investors to watch in the coming months. If that narrative builds, also keep an eye on longer dated yields at the open. This is a direct shot at the undisputed king of AI chips, Nvidia, ticker NVDA. While Nvidia recently became the first company to hit a staggering $5 trillion market capitalization, this deal positions Cerebras as a newly formidable challenger. Remember, we previously analysed how an intense rivalry concentrated in just a couple of names created a choke point. Today's move broadens the field and adds a new player alongside Nvidia. And yes, keep AMD on your radar too. However, if you zoom out, you'll see another layer of strategy at play. This isn't just about one company trying to beat another. It's part of a deliberate strategic shift across the entire AI industry. The key here is diversification. Major AI labs like OpenAI actively trying to reduce their reliance on a single hardware supplier to mitigate risk. As we discussed a while back, spreading risk across suppliers and geographies has become a core theme across the stack. This move by OpenAI is a massive signal that the era of single source dominance may be ending, which could eventually cap the incredible pricing power Nvidia has enjoyed. OpenAI is committing to purchase 750 megawatts of computing power from Cerebras through 2028, with one OpenAI executive highlighting the deal will mean faster responses and more natural interactions for its AI. Continuing our last discussion on the stack fragmenting, the focus this time shifts from general purpose GPUs to alternative architectures that can hit latency and efficiency targets at scale. Now, get this, when we talk about those faster responses, it's crucial to understand the two phases of AI development: training and inference. Training is the heavy lifting, teaching the model on vast amounts of data. But inference is when the user asks a question and the AI provides an answer. That needs to be incredibly fast. Believe it or not, the market is fragmenting beyond general purpose GPUs. We recently highlighted how big platforms are pushing deeper into custom silicon. OpenAI's big bet on Cerebras suggests they believe its specialized architecture is superior for low latency inference, creating a future where different hardware is optimized for different AI jobs. This is a stunning pivot for Cerebras. The company previously relied on a single customer, the UAE's G42, for a staggering 87% of its revenue. And here's where it gets interesting. That reliance on G42 had drawn scrutiny from US authorities concerned that advanced American AI technology could flow to strategic rivals through Middle Eastern partners. Securing a landmark deal with a premier American AI lab like OpenAI not only solves a business problem, but also a complex geopolitical one for Cerebras. And as we've said before, diversification isn't free in other parts of the ecosystem. Think reshoring's margin drag, but it does spread risk. Today, we're seeing that same risk management logic applied on the customer and compute side. But that's not the whole picture. The real turning point is the timing. Cerebras had previously filed for an IPO, only to withdraw the paperwork, with its CEO stating the business had improved in meaningful ways and needed to refile with updated information. This $10 billion deal appears to be that update, rewriting the company's narrative from a struggling IPO candidate to a major supplier for the world's leading AI lab. It all boils down to a concept called pre-IPO private validation. For a high-growth, high-cash burn tech company, a massive long-term deal with a top-tier customer is more powerful than any pitch deck. It proves the technology and the business model to Wall Street before the company even goes public, dramatically de-risking the future offering. It also acts as a real-time vote. In the broader debate we flagged a while back, tech leaders betting big on AI versus policymakers worrying about inflation. Ahead of the bell, this news sets up a major conflict. The AI arms race is no longer a one-horse race. Watch for how this development impacts shares of the giant Nvidia and the broader semiconductor sector as traders react to a newly strengthened competitor entering the ring. At the open, look for pressure on Nvidia's stock, ticker NVDA, as traders question if its long-term pricing power is now capped. Also, keep an eye on semiconductor ETFs, like the VanEck Semiconductor ETF, which trades under the ticker SMH, to gauge the reaction across the entire sector as investors begin to look for the next set of winners in this newly specialized and competitive field. As we've said a while back, also watch AMD and TSMC for clean read-throughs on accelerated demand, data center and power names for the picks and shovels angle, longer redated yields if the inflation story takes hold, and even QQQ and the VIX for signs of crowding and volatility as this leadership narrative evolves. Speaking of massive numbers with big market implications, we're shifting from a $10 billion tech deal to a figure that completely dwarfs it, a $5.3 trillion problem hiding in the US economy. That's the new annual price tag for US healthcare, a figure now consuming a massive 18% of the entire American economy and officially outpacing its growth. This level of spending puts the US in a league of its own, and not in a good way. By comparison, the latest OECD data shows the United States spends dramatically more on healthcare per person than any other developed nation. Yet, despite this massive investment, America continues to see worse health outcomes like lower life expectancy than the average of other wealthy countries. This suggests a deep and growing productivity problem where more and more money is being spent without a proportional improvement in public health, acting as a long-term drag on the US economy's potential. A new report from the Centers for Medicare and Medicaid Services reveals this surge isn't just about one single factor. First, insurance enrollment exploded. The number of people signing up for Affordable Care Act plans surged by over 30%. But the most stunning plot twist is where the cost grew fastest. It wasn't in prescriptions or doctor visits. The single biggest jump was in government administration, which skyrocketed nearly 15%. Digging one level deeper, the cost to administer Medicaid alone shot up a staggering 19.8%. Actually, this administrative surge isn't just bureaucratic bloat. It's a sign of a massive multi-year shockwave hitting the system called the Medicaid unwinding. During the pandemic, states stopped checking eligibility to ensure continuous coverage. Now, they are reevaluating millions of people, and the process is chaotic. Recent data shows over 15 million people have already been disenrolled. This creates a huge administrative burden, which we see in these numbers, and it's a developing risk for the economy. Heading into the open, investors will be watching for any signs that this could translate into a drag on state-level consumer spending or a rise in household credit problems. This all happened as hospital prices climbed at their fastest rate since 2007, pushing total hospital care spending to $1.6 trillion. So for any investor, this is a critical development. You see, these hospital costs are a key driver of what economists call sticky inflation. Healthcare services are a major component of the core PCE price index, which is the Federal Reserve's preferred gauge for inflation. When these costs rise this quickly, it makes it much harder for the Fed to get inflation back down to its 2% target. This could complicate the Fed's last mile of its inflation fight and force it to maintain a more hawkish policy stance for longer. This data puts a bright, hot spotlight on the entire healthcare ecosystem ahead of the bell. Watch for movement in major insurers like Cigna and Aetna. A key metric to watch for them is the medical loss ratio, or MLR. Think of it as the percentage of every dollar an insurer collects that it has to spend on actual medical care. Recent earnings from giants like United Health Group show this ratio is climbing sharply. This signals that rising medical costs, from hospital visits to expensive new drugs, are starting to outpace what they collect in premiums, squeezing their profit margins. This is ending the windfall period insurers enjoyed during the pandemic when many people deferred care. And you want to watch the broader healthcare select sector SPDR fund, ticker XLV, which tracks the industry. This report puts the entire healthcare sector under a microscope at the opening bell, forcing traders to decide if record spending translates to record profits or signals a system stretched to its breaking point.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.